Introduction. The financial markets have always been a grand stage where millions of participants pursue the same dream to generate profits and achieve success. Yet history shows a sobering truth. While many step into this arena with ambition, only a small fraction manage to survive, and an even smaller number rise to legendary status. These individuals, through their triumphs and failures, have shaped the very foundation of modern trading and investing. This book is not simply about celebrating their wealth or fame. It is about uncovering the principles, the discipline, and the mindset that allowed them to stand out from the crowd. Each master trader featured in these pages represents a unique philosophy, a different path to success, and a collection of hard-earned lessons that continue to inspire generations of traders and investors. The masters you will meet. Jesse Livermore, the Wall Street legend. A man whose life embodied both the heights of fortune and the depths of loss. His story is a timeless reminder of the power of patience and the danger of overconfidence. Warren Buffett, the Oracle of Omaha. The world's most respected value investor, Buffett built his empire by focusing on intrinsic worth and practicing extraordinary patience while ignoring the noise of the crowd. George Soros, the man who broke the Bank of England. Armed with deep macroeconomic insight and fearless conviction, Soros executed one of the most famous trades in history, proving the power of understanding global dynamics. Paul Tudor Jones, the risk management pioneer. Known for his legendary prediction of the 1987 crash, Jones built his career on one golden rule: protect your capital above all else. Richard Dennis, the creator of the turtle traders. Dennis demonstrated that trading is a skill that can be taught. Through the famous turtle experiment, he showed how discipline and system can transform novices into professionals. Ray Dalio, the architect of principles. Founder of Bridgewater Associates, Dalio combines economic insight with a philosophy of radical transparency and diversification, creating one of the most resilient hedge funds in history. What this book offers. The purpose of this book is not to turn you into another Livermore, Soros, or Buffett. Each of these figures lived in different times, under unique circumstances, and faced their own challenges. Instead, the goal is to help you absorb their wisdom, understand their philosophies, and apply the timeless lessons they left behind. You will discover that there is no single path to success in the markets. Some masters thrived by following trends, others by digging deep into fundamentals, and others by reading macroeconomic shifts. Yet all of them share three universal traits: discipline, patience, and risk control. By the end of this journey, you will not only understand how these traders thought and acted, but also be able to reflect on your own trading journey. Their lessons are not relics of history. They are tools you can use today to shape your future in the markets. Jesse Livermore, the Wall Street legend. Jesse Livermore remains one of the most captivating figures in the history of Wall Street, a trader whose life embodied both the soaring heights of financial triumph and the crushing lows of repeated failure. His story is one of brilliance, ambition, discipline, and ultimately tragedy. Yet, despite the dramatic turns of his career, the principles he articulated and lived by continue to serve as a foundation for modern trading. For those who seek to understand markets not only through charts and numbers, but also through psychology and discipline, yet Livermore's life offers an extraordinary case study. Born in 1877 in Shrewsbury, Massachusetts, Livermore's journey into trading was unconventional. At the age of 14, he left school with his mother's encouragement and began working in a Boston bucket shop. These establishments were not actual exchanges, but rather betting parlors where customers speculated on stock price movements without owning the securities. The environment provided a fertile training ground for young Jesse. Armed with a chalkboard and a keen memory, he observed price action, patterns, and the psychology of the crowd. Very quickly, he developed an instinctive sense of how prices moved and why. His early success was so remarkable that bucket shops across Boston banned him from trading because he was consistently draining their profits. At just 15, Livermore moved to New York City, the beating heart of American finance. There, he began trading on the New York Stock Exchange. His reputation as the boy plunger grew rapidly, a nickname earned for his willingness to take bold positions and for his uncanny ability to profit during volatile swings. One of his early coups came during the Panic of 1907, when he famously shorted the market and earned a fortune estimated at $3 million, an astronomical sum at the time. This success cemented his status as a Wall Street legend in the making and demonstrated his ability to read markets when fear gripped the majority. But Livermore's story was never a straight line upward. The same boldness that produced his greatest victories often contributed to his deepest failures. While his trading philosophy stressed patience, discipline, and risk management, Livermore himself struggled to consistently adhere to his own principles. He won and lost multiple fortunes throughout his career, each cycle reminding him and the world of the razor-thin line between triumph and disaster in trading. What made Jesse Livermore extraordinary was not simply the size of his profits, but the sophistication of his approach. Long before the era of advanced technical analysis, he emphasized the importance of studying price movements and interpreting market behavior. He believed that the market itself tells the truth and that successful traders must learn to listen. Livermore was not a fundamental analyst in the conventional sense. He cared little about company earnings or balance sheets. Instead, he observed trends, breakouts, and the actions of the crowd. He understood that markets are driven not only by information, but also by emotion, fear, greed, hope, and despair. Livermore's philosophy can be distilled into several key principles. First, he stressed patience. The big money, he once explained, is not in the buying or the selling, but in the waiting. This simple yet profound insight highlights the necessity of holding positions through the noise of daily fluctuations to capture the larger trend. Second, he emphasized the importance of trading with the market rather than against it. In his view, trying to fight prevailing trends was a fool's errand. Third, he underscored risk management. Livermore was a strong advocate of using stop-loss orders to cut losing trades quickly before they grew into unmanageable disasters. Ironically, despite his emphasis on discipline, there were times when he failed to follow these very rules, and those lapses often led to catastrophic losses. The pinnacle of Livermore's career came during the stock market crash of 1929. By carefully observing the speculative mania of the Roaring Twenties, he recognized that the market had entered dangerous territory. Leveraged buying, rampant speculation, and overvalued equities created conditions ripe for collapse. Trusting his analysis and ignoring the euphoria around him, Livermore began building massive short positions. When the crash arrived, he profited spectacularly, earning over $100 million in the span of weeks. Adjusted for today's dollars, this fortune would translate into several billions. Newspapers hailed him as the Great Bear of Wall Street, and his fame reached legendary proportions. At the same time, his actions attracted widespread resentment, as the public viewed him as someone who had profited from their misery. Yet even at the height of his wealth, Livermore's story revealed the darker side of trading. Financial success did not bring him personal peace. His personal life was plagued with turmoil, failed marriages, and strained relationships. Despite amassing and losing fortunes multiple times, his inability to manage personal emotions proved as destructive as any market downturn. By the mid-1930s, Livermore's fortune had dwindled, and in 1940, at the age of 63, he tragically took his own life in a New York hotel. His passing shocked the financial community and cemented his reputation as a tragic genius, a man who could read the markets with extraordinary precision but could not conquer his own inner battles. For modern traders, Jesse Livermore's life is both inspiring and cautionary. His methods anticipated many principles of technical trading used today: trend following, breakout strategies, and the interpretation of price action. His insistence on patience and discipline remains relevant in an age where technology tempts traders to overtrade and chase every fluctuation. His emphasis on risk management is more critical than ever, given the leverage and speed of modern markets. But equally important are the warnings his life provides. Success in trading is not only about skill and analysis, it is also about emotional stability, consistency, and the ability to manage one's own psychology. One striking element of Livermore's career is how it illustrates the cyclical nature of markets and of human behavior. Time and again, he observed how greed pushed prices to unsustainable levels, only for fear to drive them down with equal intensity. These cycles of boom and bust are not relics of the past. They continue to define markets today. By studying Livermore, traders can better prepare themselves for the inevitability of such cycles and avoid being swept away by the prevailing sentiment of the crowd. Another enduring lesson is the critical role of self-discipline. Livermore's greatest failures occurred not because his methods were flawed, but because he failed to follow them. This paradox highlights a truth that every trader must confront. The battle is not only against the market, but also against oneself. Developing a system is relatively straightforward. Adhering to it with consistency is the true challenge. Livermore's story underscores that the discipline to follow one's own rules often determines long-term success or failure. Finally, Livermore's legacy demonstrates that wealth alone does not guarantee fulfillment. He achieved financial heights most can only dream of, yet he struggled with personal contentment and peace of mind. For traders today, this is a reminder that success in the markets must be balanced with a broader sense of purpose and well-being. Financial gains, no matter how large, cannot substitute for stability in other areas of life. In conclusion, Jesse Livermore remains a towering figure in trading history, not only because of his spectacular wins and losses, but because of the timeless lessons his journey imparts. He was a man of extraordinary insight who mastered the language of markets, yet struggled to master himself. His principles of patience, trend following, and risk management continue to guide traders nearly a century later. At the same time, his failures warn against arrogance, overconfidence, and the dangers of ignoring one's own rules. To study Livermore is to understand the dual nature of trading. It is a path of immense opportunity, but one fraught with peril for those who underestimate the psychological demands it imposes. His life, in all its brilliance and tragedy, remains one of the greatest stories ever told on Wall Street, and one that every trader, novice or experienced, should take to heart. Warren Buffett, the Oracle of Omaha. Warren Buffett is perhaps the most iconic investor of the modern era, a man whose name has become synonymous with discipline, patience, and the pursuit of value. Born in 1930 in Omaha, Nebraska, Buffett transformed himself from a boy fascinated by numbers and business into the chairman and CEO of Berkshire Hathaway, one of the most successful conglomerates in history. Known around the world as the Oracle of Omaha, Buffett's story is not only about the accumulation of extraordinary wealth, but also about the creation of a philosophy of investing that has reshaped how generations approach the markets. From an early age, Buffett displayed an unusual fascination with business and investing. At the age of 11, he purchased his first stock, Cities Service Preferred, buying 3 shares for himself and 3 for his sister. That small trade offered a lesson he would never forget. After buying at $38 per share, the stock dropped to $27 before recovering to $40. Impatient, young Warren sold his shares only to watch the price climb above $200 in the following years. That early experience taught him 2 truths that would define his career: the importance of patience and the cost of short-term thinking. Buffett's formative years were marked by a relentless quest for knowledge. He devoured books on investing, most notably Benjamin Graham's The Intelligent Investor, which introduced him to the concept of value investing. Graham emphasized buying securities trading below their intrinsic value, a philosophy rooted in rational analysis rather than speculation. Inspired by Graham, Buffett enrolled at Columbia Business School, where he studied under the master himself. This mentorship shaped Buffett's framework and instilled in him a belief that successful investing requires both discipline and independence of thought. After a brief stint working for Graham, Buffett returned to Omaha and launched his own investment partnership in the 1950s. With modest beginnings, he pooled capital from family and friends and applied the principles he had learned. The results were nothing short of extraordinary. Year after year, his partnership outperformed the market by a wide margin, establishing Buffett as a rising star in the world of investing. By the mid-1960s, Buffett had taken control of Berkshire Hathaway, then a struggling textile company, and began transforming it into a vehicle for long-term investments. The textile operations eventually faded, but Berkshire itself became the cornerstone of Buffett's empire. Buffett's philosophy is deceptively simple, but remarkably effective. At its core is the concept of intrinsic value, the true worth of a business based on fundamentals such as earnings, assets, and long-term potential. Buffett seeks companies with durable competitive advantages, which he calls economic moats, protecting them from competitors. He prefers businesses with consistent profitability, strong management, and products or services that people will continue to need decades into the future. Equally important is his insistence on buying at a fair or discounted price, ensuring a margin of safety. One of Buffett's most enduring lessons is his focus on the long term. In contrast to traders who seek to profit from short-term fluctuations, Buffett believes that time is the investor's greatest ally. He often remarks that his favorite holding period is forever. This philosophy allows him to ride out volatility, avoid the temptation of market timing, and capture the compounding effect of returns over decades. The results are undeniable. A single dollar invested in Berkshire Hathaway in the 1960s has grown into hundreds of thousands today, a testament to the power of long-term compounding. Buffett is also known for his temperament, which may be his greatest advantage over the average investor. He has the rare ability to remain calm when others panic and cautious when others grow euphoric. His famous dictum, "Be fearful when others are greedy, and greedy when others are fearful," captures this contrarian mindset. During times of crisis, such as the 2008 financial meltdown, Buffett deployed capital into companies like Goldman Sachs and General Electric, securing favorable terms and reaping massive returns once markets stabilized. His ability to act decisively in moments of fear highlights both his courage and his adherence to principles. Yet Buffett's success is not simply about picking stocks. He has also been a master at identifying and partnering with outstanding management teams. He famously avoids businesses he does not understand, such as most technology companies, and instead invests in companies with straightforward models run by competent and trustworthy leaders. His acquisitions of companies like See's Candies, Geico, and Dairy Queen demonstrate his preference for businesses with enduring appeal and reliable cash flows. These acquisitions reflect a philosophy that values quality over quantity and stability over speculation. An equally important part of Buffett's story is his partnership with Charlie Munger, his longtime vice chairman at Berkshire Hathaway. Munger influenced Buffett to move beyond the strict value approach of Graham and focus more on the quality of businesses. While Graham often invested in average companies trading at low prices, Buffett, under Munger's influence, began emphasizing great businesses at fair prices. This evolution in thinking allowed Berkshire to build a portfolio of companies that not only survived, but thrived over decades. Despite his immense wealth, Buffett's lifestyle remains famously modest. He still lives in the Omaha house he purchased in 1958 for $31,000. He drives his own car, eats simple meals, and avoids the trappings of extravagant living. This frugality is not just a quirk, but an extension of his philosophy. Wealth should be measured by freedom and security, not by consumption. Moreover, Buffett has pledged to donate the majority of his fortune to philanthropic causes, underscoring his belief in giving back to society. For traders and investors alike, Buffett's story holds multiple lessons. First, it demonstrates the value of patience. Markets are filled with noise, but wealth creation comes from staying the course with sound investments. Second, it illustrates the importance of independent thinking. Buffett often invests contrary to the consensus, relying on his own analysis rather than following the crowd. Third, it highlights the critical role of discipline. Buffett rarely strays from his principles, resisting the temptations of speculation even during market frenzies. Perhaps the most significant lesson from Buffett's career is that success in the markets is not about brilliance alone, but about temperament. Intelligence is necessary, but emotional stability, humility, and consistency matter more. As he often points out, the market is designed to transfer wealth from the impatient to the patient. Those who can withstand volatility and remain true to their strategy are the ones who ultimately succeed. Buffett's legacy extends beyond his wealth and his company. Through his annual shareholder letters, he has shared decades of wisdom in plain, accessible language. These letters have become required reading for investors worldwide, blending humor, candor, and profound insight. They reflect his belief that financial education should be open and honest, demystifying markets rather than complicating them. In contrast to Jesse Livermore, whose life was marked by extreme highs and lows, Buffett's story is one of steady, compounding success built on discipline and consistency. Where Livermore thrived in volatility but struggled with personal demons, Buffett thrived through patience and a clear framework that allowed him to avoid catastrophic mistakes. Together, their stories reveal two contrasting but equally valuable perspectives on the markets. Warren Buffett's journey underscores that true investing is not a race for quick profits, but a lifelong discipline rooted in rationality and principle. He has proven that extraordinary results can come from ordinary actions repeated consistently over time. For modern investors navigating a world of instant information and constant distraction, Buffett's example is a reminder that the simplest approach, grounded in patience, discipline, and common sense, can be the most powerful of all. George Soros, the man who broke the Bank of England. George Soros stands as one of the most polarizing and fascinating figures in the world of finance. To some, he is the brilliant hedge fund manager who forever altered the playbook for global macro trading, a man who combined intellectual depth with fearless execution to amass one of the greatest track records in investment history. To others, he is a controversial figure whose speculative bets shook economies and challenged governments, earning him both admiration and resentment. Regardless of perspective, Soros's career offers timeless lessons about risk, conviction, market psychology, and the power of bold ideas put into action. Early life and the roots of resilience. George Soros was born in Budapest, Hungary in 1930 into a Jewish family during a turbulent time in European history. His formative years were shaped by survival. As a teenager, he lived through the Nazi occupation of Hungary, narrowly escaping persecution. These experiences instilled in him a profound resilience, a deep skepticism of rigid systems, and an understanding of how fragile political and economic structures could be. Later, he would often say that those years gave him the ability to think independently and to question authority, traits that defined his career in finance. After the war, Soros emigrated to England, where he enrolled at the London School of Economics. There he encountered Karl Popper, the philosopher who profoundly influenced his thinking. Popper's philosophy of open societies and his concept of fallibility became the foundation of Soros's intellectual framework. Soros concluded that human beings are inherently flawed in their perception of reality, and markets, being composed of humans, reflect these biases. From this seed grew the theory of reflexivity, a cornerstone of his trading approach. Entering finance and the birth of the quantum fund. Soros began his career modestly. He worked as a clerk and later as an arbitrage trader in London before moving to New York in the 1950s. There he found opportunities on Wall Street, initially focusing on European securities. By 1973, he co-founded the Quantum Fund with Jim Rogers. This fund became one of the most successful hedge funds in history, generating average annual returns in excess of 30% over decades. Unlike many investors who focused narrowly on equities, Soros approached markets from a global macro perspective. He looked at currencies, commodities, bonds, and equities across the world, seeking to profit from broad economic trends. His ability to synthesize information from politics, economics, and psychology gave him a unique edge. He was not merely reacting to market movements. He was anticipating shifts in the global financial architecture. The theory of reflexivity. At the core of Soros's success lies his theory of reflexivity. In contrast to the prevailing efficient market hypothesis, which argues that markets accurately reflect all available information, Soros believed markets are inherently flawed because participants act on their perceptions, not objective reality. In practice, this means that investors' beliefs can influence the fundamentals themselves. For example, if investors believe a company is strong, they may buy its stock, pushing prices higher. The rising stock price then enables the company to raise capital more easily, making the business genuinely stronger. In this way, perception and reality feed into each other in a feedback loop. Conversely, pessimism can drive prices down, weaken balance sheets, and become a self-fulfilling prophecy. This insight allowed Soros to spot bubbles and crises before others. He understood that markets do not move smoothly toward equilibrium, but rather oscillate between extremes of optimism and pessimism. By recognizing these distortions, Soros positioned himself to profit from both manias and collapses. Black Wednesday, breaking the Bank of England. Soros's most famous trade, the one that cemented his reputation in financial history, occurred in September 1992. At the time, the United Kingdom was part of the European Exchange Rate Mechanism, ERM, a system designed to stabilize European currencies before the adoption of the euro. The British government had committed to maintaining the pound within a fixed band relative to the Deutsche Mark. Soros recognized that this commitment was unsustainable. The British economy was struggling, inflation was high, and interest rates were not aligned with the requirements of the ERM. Maintaining the pound's value required keeping interest rates at levels damaging to domestic growth. Soros and his team at the Quantum Fund concluded that the pound was massively overvalued and that sooner or later the government would be forced to devalue or abandon the ERM peg. In anticipation, Soros built a massive short position against the pound, borrowing and selling tens of billions of pounds in the currency markets. On September 16, 1992, known as Black Wednesday, the Bank of England attempted to defend the pound by raising interest rates and buying its own currency. But the pressure from Soros and other speculators was overwhelming. By the end of the day, Britain was forced to withdraw from the ERM, and the pound collapsed in value. Soros's fund made over $1 billion in profit from that single trade. While the British government and taxpayers bore the cost, Soros's reputation skyrocketed. He became forever known as the man who broke the Bank of England. Beyond Black Wednesday, triumphs and setbacks. While the 1992 trade is the most famous, Soros's career was filled with both triumphs and setbacks. His quantum fund generated consistent outsized returns, making him one of the wealthiest individuals in the world. He profited from global trends in emerging markets, commodities, and interest rates, often taking large and concentrated bets. Yet Soros was not infallible. In the late 1990s, he misjudged aspects of the Asian financial crisis and suffered significant losses in Russia's default. He himself admitted that he was wrong as often as he was right, but what set him apart was his ability to cut losses quickly and to double down when conviction was high. Soros often described his trading process as deeply instinctual, guided not only by analysis but also by a physical sense, famously claiming that his back pain would worsen when his positions were wrong. Risk-taking and conviction. One of the defining traits of Soros's career is his willingness to take massive risks when his analysis convinced him. He was not a cautious, incremental investor. When he saw an opportunity, he went all in, betting billions on a single trade. But this was not recklessness. It was a calculated expression of conviction. He believed that great opportunities are rare, and when they appear, one must act decisively. At the same time, Soros understood the importance of risk management. He was willing to change his mind quickly, to exit positions without hesitation when the facts changed. This combination of boldness and flexibility is what allowed him to survive and thrive in the volatile world of global macro trading. Philanthropy and public influence. Beyond finance, Soros became one of the most significant philanthropists of his generation. Through his open society foundations, he donated tens of billions of dollars to promote democracy, human rights, education, and public health around the world. His commitment to building open societies reflects the influence of Karl Popper's philosophy, showing how his intellectual foundation extended far beyond trading. Soros's political activism and philanthropy also made him a target of criticism. Governments he opposed accused him of meddling in internal affairs, while conspiracy theories often exaggerated his influence. Nevertheless, his philanthropic legacy is undeniable, shaping civil society across Eastern Europe, Africa, and beyond. Lessons from Soros. For traders and investors today, George Soros offers several enduring lessons. 1. Markets are not rational. Human perception shapes reality, and markets are driven by feedback loops of optimism and pessimism. Recognizing this gives an edge. 2. Conviction must be paired with risk management. Soros's willingness to bet big was always balanced by his readiness to admit mistakes and cut losses quickly. 3. Flexibility is essential. He often reversed his positions without hesitation when new evidence emerged. Stubbornness is a trader's enemy. 4. Courage to challenge consensus. Soros built his fortune by going against the crowd when he believed the crowd was wrong. 5. Think globally. His success came from looking beyond one market or asset class, analyzing the interconnectedness of currencies, bonds, equities, and politics worldwide. 6. The importance of philosophy. Soros's intellectual foundation in reflexivity gave him a framework to interpret markets in a unique way. Great traders often have a worldview that guides their decisions. Legacy: George Soros remains a controversial figure, but his impact on finance is unquestionable. He proved that markets are not merely mechanical systems, but living organisms shaped by human belief. He demonstrated the power of global macro trading and inspired generations of hedge fund managers to follow in his footsteps. To call him merely a trader would be an understatement. Soros is both a financial legend and a thinker who bridged philosophy and markets. His career, with its spectacular highs and painful lows, encapsulates the essence of speculation: uncertainty, courage, fallibility, and the pursuit of opportunity. For anyone seeking to understand how markets truly function and how great fortunes are made and lost, the story of George Soros is indispensable. Paul Tudor Jones, master of risk management. Paul Tudor Jones is regarded as one of the greatest traders of the modern era, a man whose career exemplifies discipline, foresight, and the power of risk management. While many traders throughout history have been remembered for legendary trades or short bursts of success, Jones has sustained excellence over decades in the most competitive arenas of global finance. His journey from a young man with ambition in Memphis, Tennessee, to the founder of Tudor Investment Corporation and a widely respected philanthropist offers both inspiration and practical lessons for traders today. Jones was born in 1954 in Memphis, where he grew up in an environment that valued education and persistence. After graduating from the University of Virginia with a degree in economics, he initially considered law school, but soon realized that his true passion lay elsewhere. His cousin introduced him to the world of trading, and Jones began his career as a clerk on the trading floor. This early exposure to the raw energy of the markets shaped his professional identity. The trading pits were chaotic and unforgiving, but they were also meritocratic. If one had the skill, resilience, and sharp instincts, success was within reach. Jones quickly realized he had a talent for understanding price action, and he combined this with an unmatched drive to master the art of speculation. In the early stages of his career, Jones worked for legendary commodity trader Eli Tullis in New Orleans. Under Tullis's mentorship, he learned lessons that would define his philosophy. The importance of discipline, the need to respect risk, and the value of emotional control were drilled into him on a daily basis. He also learned that while markets constantly change, human nature remains remarkably consistent, and that is why patterns of greed and fear repeat over time. Tullis's teachings resonated deeply, and Jones carried them with him throughout his career. By 1980, Paul Tudor Jones was ready to launch his own firm, Tudor Investment Corporation. His ambition was not just to trade for himself, but to build an enduring institution capable of delivering returns across multiple market cycles. The timing could not have been better. The late 1970s and early 1980s were years of volatility in commodities, currencies, and equities, offering abundant opportunities for those who could anticipate major shifts. Jones was a master at combining macroeconomic analysis with technical insights, always grounding his trades in a framework that emphasized capital preservation. He once said that the most important rule of trading is to play great defense, not great offense, underscoring his conviction that survival is the foundation of profitability. His fame reached new heights during the stock market crash of October 1987. Jones had studied historical market collapses extensively, particularly the crash of 1929, and believed that conditions were building for a similar decline. Through a combination of meticulous research and instinct, he positioned his fund short ahead of the market collapse. When the Dow Jones Industrial Average plummeted by more than 20% in a single day, Tudor Investment Corporation generated enormous profits. That trade cemented Jones's reputation as a trader with not only vision, but also the courage to act decisively, Importantly, it also highlighted his ability to thrive in moments when fear dominated the markets. While others panicked, he executed his plan with precision. Yet Jones's career cannot be reduced to one historic event. Over the decades, he consistently generated strong returns by adhering to his principles of flexibility and risk management. Unlike some traders who rigidly follow a single style, Jones evolved with the markets. He combined elements of global macro trading, trend following, and technical analysis, adapting his methods as conditions changed. This adaptability has been a defining feature of his longevity. He often emphasized that ego is the enemy of a trader. Once someone becomes wedded to a particular idea or method, they risk being blindsided by new realities. For Jones, the willingness to cut losses quickly and reassess a situation is a hallmark of professionalism. Risk management is at the heart of his philosophy. Jones famously never risks more than a small percentage of his capital on a single trade. He also uses stop-loss orders rigorously, ensuring that no single mistake can destroy his portfolio. He believes that the key to long-term survival is controlling downside risk, because as long as capital is preserved, opportunities will always present themselves. This perspective reflects a deep understanding of probability and psychology. Even the best traders are wrong a significant portion of the time, and without proper risk control, the law of large numbers will eventually crush them. By ensuring that his losses are always limited, Jones protects himself from the devastating effects of randomness and market shocks. His emphasis on mental discipline is equally significant. Jones has spoken openly about the importance of emotional stability and self-awareness in trading. He understands that markets are designed to exploit human weaknesses, especially the tendency to overtrade, to cling to losing positions, or to let euphoria cloud judgment. He encourages traders to maintain a humble mindset and to view losses as part of the process rather than as personal failures. This humility is what keeps him sharp after decades in the markets. Beyond trading, Jones is known for his philanthropy and his commitment to social causes. In 1988, he founded the Robin Hood Foundation, which has since become one of the most impactful anti-poverty organizations in the United States. The foundation applies rigorous, results-oriented principles to philanthropy, mirroring the discipline Jones brings to his trading. His belief is that success in finance comes with a responsibility to give back, to use capital and influence for broader societal good. This dual legacy, financial acumen combined with philanthropy, distinguishes him from many other traders who focus solely on personal wealth accumulation. Jones's career also offers valuable insights into the role of intuition and experience in trading. He often trusts his instincts, honed by years of watching markets tick by tick. While data and analysis are essential, there are moments when gut feel, informed by deep familiarity with market behavior, can be decisive. He compares this to a seasoned athlete who can sense the flow of the game beyond what statistics reveal. This blend of intuition and discipline is rare and helps explain his enduring edge. Another key element of Jones's philosophy is the recognition that markets are cyclical and that periods of opportunity are followed by periods of difficulty. He encourages traders to avoid overconfidence during winning streaks and to remain vigilant for changing conditions. His ability to step back, reduce exposure, and wait for high-probability setups is part of why he has lasted so long in a business that regularly humbles even the most talented participants. Paul Tudor Jones also emphasizes the importance of mentorship and education. He has inspired countless traders through interviews, speeches, and his visible example. He advocates for continuous learning, reminding traders that complacency is dangerous. Markets are constantly evolving, influenced by new technologies, regulations, and global forces. To succeed, one must evolve as well. His own willingness to learn from mistakes and adjust course has been critical to his resilience. The lessons from Jones's career are timeless. First, risk management is non-negotiable. Without it, even the most brilliant analysis is worthless. Second, flexibility and adaptability are crucial. Traders must be willing to abandon ideas that no longer work. Third, humility and discipline are the foundation of psychological stability in the markets. Fourth, success is not just about making money, but about using it responsibly, as Jones has done through philanthropy. Finally, longevity is the ultimate measure of a trader's skill. Many can achieve short bursts of success, but only those who master risk and themselves can endure across decades. In conclusion, Paul Tudor Jones stands as a master of risk management, a trader whose career has combined boldness with caution, instinct with discipline, and personal success with social responsibility. His story illustrates that true greatness in trading is not about a single spectacular win, but about sustained excellence built on principles that withstand the test of time. For traders seeking inspiration, his example provides a roadmap. Protect capital, remain flexible, cultivate humility, and strive for impact beyond oneself. These are the qualities that elevate Jones from a successful trader to a true legend of Wall Street. Ray Dalio, Principles and Bridgewater Legacy. Ray Dalio stands as one of the most influential investors and thinkers in modern finance. His career has been defined not only by extraordinary investment performance, but also by his revolutionary approach to organizational culture, decision-making, and risk management. As the founder of Bridgewater Associates, the largest hedge fund in the world, Dalio transformed the way institutional investors think about diversification, macroeconomic cycles, and the role of principles in guiding behavior. His journey is not merely the story of a successful money manager, but the blueprint of how to build a lasting financial institution rooted in intellectual honesty and systematic decision-making. Dalio was born in 1949 in Jackson Heights, Queens, to a middle-class family. His father was a jazz musician, and his upbringing was far from the environment of Wall Street privilege. Yet, like many great investors, his interest in markets began early. At the age of 12, Dalio bought shares of Northeast Airlines after overhearing a tip from golfers while caddying. When the airline later merged and his small stake tripled in value, he was hooked on the markets. This early experience instilled in him both the allure of speculation and the understanding that information could create opportunity. He went on to study finance at Long Island University before earning his MBA from Harvard Business School. But Dalio's career was not a straight path upward. His first jobs included working on the commodities floor of the New York Stock Exchange and serving as a clerk at Shearson Hayden Stone. These early years exposed him to the chaotic and cyclical nature of markets, and he began forming views about how global events and government policies interacted with market dynamics. In 1975, Dalio founded Bridgewater Associates out of his two-bedroom apartment in New York. The firm started small, providing risk consulting and advising corporations on managing interest rate and currency exposures. Over time, Bridgewater evolved into a global macro hedge fund, attracting institutional clients like pension funds and sovereign wealth funds. Dalio's unique ability to synthesize economic theory with practical market insight quickly distinguished him from peers. He was not just trading securities. He was building systems to understand how the entire world economy functioned. One of Dalio's greatest contributions to the investment world is his concept of radical transparency. At Bridgewater, employees are encouraged, even required, to challenge ideas openly, regardless of hierarchy. Meetings are recorded, feedback is brutally honest, and decision-making is dissected with the precision of a surgeon. Dalio believed that ego and fear of criticism cloud human judgment, while transparency exposes weaknesses and forces constant improvement. This culture, although controversial, became a defining feature of Bridgewater's success and resilience. Dalio is equally famous for his principle of believability-weighted decision-making. Instead of relying on consensus or hierarchy, Bridgewater assigns greater weight to the opinions of those with proven track records in specific domains. This approach blends meritocracy with data-driven analysis, allowing the best ideas to rise to the top. For Dalio, running a hedge fund was not only about predicting markets, but also about engineering a process that could consistently generate insights and manage risks over decades. Dalio's investment philosophy is deeply rooted in studying historical patterns. He believes that while markets appear unpredictable in the short term, they operate according to recurring long-term cycles driven by human behavior, debt accumulation, monetary policy, and productivity growth. His framework for understanding the economy is built around the long-term debt cycle, which spans decades and shapes everything from interest rates to equity returns. By comparing current conditions to historical precedents, Dalio developed a systematic approach that allowed Bridgewater to navigate both booms and busts with remarkable accuracy. Perhaps the most famous demonstration of Dalio's foresight came during the 2008 financial crisis. Bridgewater's flagship fund, Pure Alpha, generated strong positive returns at a time when most funds were collapsing. Dalio's team had anticipated the unsustainable buildup of leverage in the global system and positioned accordingly. This not only reinforced his reputation as a master of risk management, but also demonstrated the effectiveness of his research-driven, principle-based approach. Dalio is also known for his philosophy of diversification, which he terms the holy grail of investing. He emphasizes that holding multiple uncorrelated assets can reduce risk without sacrificing return. His all-weather portfolio, designed to perform across different economic environments, whether inflationary, deflationary, growth-driven, or contractionary, has become a widely studied model in portfolio management. The core insight is that no one can predict the future with certainty, but by preparing for a range of scenarios, investors can achieve more consistent outcomes. Beyond markets, Dalio's intellectual legacy is encapsulated in his book Principles, where he lays out both life principles and work principles. The book, which has sold millions of copies, distills decades of experience into guiding rules that can be applied not only to investing, but also to decision-making in business and personal life. Dalio stresses the importance of embracing reality, confronting truth, and constantly learning from mistakes. To him, setbacks are not failures, but opportunities to evolve. His mantra, pain plus reflection equals progress, captures this philosophy succinctly. Dalio's reflections extend to the broader functioning of societies and economies. In his writings, he has warned about rising income inequality, political polarization, and the risks of unsustainable debt burdens. He draws parallels between current times and previous historical periods, such as the Great Depression or the decline of past empires, urging policymakers and investors to prepare for structural shifts rather than assuming stability will persist indefinitely. While Dalio's career has been filled with extraordinary success, he has also faced criticism. Some former employees argue that Bridgewater's radical transparency creates an environment of excessive pressure. Others question whether his macroeconomic models are too rigid. Yet, the fact that Bridgewater has endured for decades and remains one of the most influential hedge funds speaks to the durability of his ideas and systems. Dalio himself often admits that he is not always right, but his focus on building robust processes ensures that mistakes become learning opportunities rather than fatal errors. As Dalio has stepped back from day-to-day management, his focus has increasingly turned toward philanthropy and global thought leadership. Through the Dalio Foundation, he has donated billions to causes ranging from education to healthcare to ocean exploration. His mission is not only to preserve wealth, but also to contribute to solving humanity's most pressing challenges. This extension of his principles beyond the trading floor reinforces his belief that success must serve a greater purpose. For traders and investors, the lessons from Ray Dalio are profound. First, rigorous principles are essential for navigating complex systems. Success cannot depend on intuition alone. It requires structured frameworks that allow for consistent decision-making. Second, diversification and risk management are more powerful than bold predictions. By preparing for multiple outcomes, investors can survive and thrive across economic cycles. Third, culture matters. Whether in a hedge fund or in personal life, fostering honesty, openness, and learning creates resilience. Dalio's legacy is not confined to the billions managed at Bridgewater. His influence extends into how businesses think about leadership, how policymakers analyze debt cycles, and how individuals can live with greater self-awareness. Few figures have bridged the gap between finance, philosophy, and philanthropy as effectively as he has. In many ways, Ray Dalio represents the evolution of Wall Street, from pure speculation to systematic, principle-driven management. He shows that lasting success is not about chasing every opportunity, but about creating a durable foundation rooted in timeless truths. Just as Bridgewater weathered storms by preparing for them in advance, Dalio's broader message to the world is clear. Embrace reality, learn from history, and let principles guide the way forward. The legacy of Ray Dalio is thus not just measured in investment returns, but in the frameworks and philosophies that will continue to shape financial thinking for generations. His journey from a curious caddy overhearing stock tips to the founder of the largest hedge fund in the world embodies the transformative power of disciplined curiosity and principled leadership. For aspiring traders, investors, and leaders, the lesson is unmistakable. Principles endure, and those who build on them can leave a legacy that transcends markets. Stanley Druckenmiller, the consistent macro trader. Stanley Druckenmiller is widely regarded as one of the greatest traders in modern financial history, admired not only for his outstanding returns, but also for the consistency with which he achieved them. While many traders are remembered for a single bold bet or for spectacular short-term profits, Druckenmiller stands out for delivering extraordinary results over decades. From his early days at Pittsburgh National Bank to his legendary years at Duquesne Capital and his collaboration with George Soros at the Quantum Fund, Druckenmiller's career offers invaluable lessons about discipline, risk management, macroeconomic analysis, and the psychology of trading at the highest level. His ability to integrate a broad view of the global economy with precise timing and execution makes him a unique figure whose strategies remain highly relevant in today's volatile markets. Druckenmiller was born in Pittsburgh in 1953 in a middle-class family, and his early environment gave him a strong work ethic and an appreciation for calculated risk. After earning a degree in economics from Bowdoin College and later attending graduate school at the University of Michigan, he quickly entered the financial industry. His first job at Pittsburgh National Bank placed him in an environment where he could blend academic theory with real-world financial analysis. By his mid-20s, he was already managing significant capital, demonstrating not only intelligence, but also remarkable confidence. Unlike many traders who emerge from humble beginnings and struggle with initial failures, Druckenmiller displayed early signs of his ability to balance analytical rigor with bold decision-making. His major career breakthrough came when he founded Duquesne Capital Management in 1981. Starting with modest assets, he built an impressive track record by applying macroeconomic analysis to asset allocation, currencies, fixed income, and equities. What set him apart from many contemporaries was his ability to remain flexible. He often said that the key to his success was not being right all the time, but cutting losses quickly when wrong and pressing hard when right. This asymmetric approach, limiting downside and amplifying upside, became a hallmark of his trading philosophy. Druckenmiller's career reached legendary status in the late 1980s when George Soros hired him to help manage the Quantum Fund. At Quantum, Druckenmiller was thrust into the center of some of the most ambitious and consequential trades in financial history. He was deeply involved in the 1992 shorting of the British pound, which made Soros famous as the man who broke the Bank of England. While Soros often gets the spotlight for that trade, Druckenmiller himself has acknowledged that he was the one who initially proposed shorting the pound, though Soros later magnified the position to unprecedented levels. Together, their collaboration demonstrated the perfect balance of vision and execution. Druckenmiller's disciplined analysis paired with Soros's willingness to size up positions aggressively. One of the central lessons from Druckenmiller's career is his philosophy on risk management. He repeatedly emphasizes that successful trading is not about making small, consistent gains, but about protecting capital and being prepared to act decisively when the odds tilt strongly in one's favor. He often advises young traders that the biggest mistakes in markets come not from being wrong, but from staying wrong. His willingness to quickly acknowledge mistakes and shift strategies is a quality that separates him from many traders who let ego dictate their decisions. Druckenmiller has stated in interviews that he never had a losing year at Duquesne Capital, an extraordinary feat considering the volatility of global markets over several decades. Another cornerstone of his success lies in his macroeconomic perspective. Druckenmiller is not a technical trader in the traditional sense. He does not rely heavily on chart patterns or purely quantitative signals. Instead, he seeks to understand the larger forces driving markets, such as monetary policy, fiscal dynamics, demographic trends, technological shifts, and geopolitical risks. His approach is sometimes called top-down investing, where one begins with the global picture and then identifies the specific assets most likely to benefit from or suffer under those macro trends. This method requires not only vast knowledge, but also intellectual humility, as global macro trends can shift quickly and unexpectedly. An illustrative example of his adaptability came during the technology boom of the late 1990s. Druckenmiller initially underestimated the staying power of the tech rally, maintaining a skeptical stance about valuations. However, once he recognized the strength of the trend, he adjusted his portfolio aggressively, riding the wave of technology stocks to substantial profits. Later, he admitted that one of his greatest regrets was exiting the tech sector too early in 2000, missing out on even larger potential gains before the bubble finally burst. This admission reflects a key quality of Druckenmiller. He is transparent about his mistakes and uses them as teaching points rather than hiding them. The consistency of his returns also highlights another crucial element of his strategy: capital preservation. Druckenmiller was never afraid to go to cash or significantly reduce exposure when market conditions were uncertain. Many traders feel compelled to always be active in markets, fearing that inactivity signals weakness. Druckenmiller rejected that mindset, insisting that patience is just as much a weapon as aggression. By waiting for high-probability setups, he avoided unnecessary drawdowns and preserved mental clarity for when genuine opportunities arose. His years managing Duquesne Capital produced one of the most impressive records in hedge fund history. From its inception in 1981 until its closure in 2010, the fund reportedly returned an average of more than 30% annually without a single losing year. This record places him in an elite category alongside figures like Warren Buffett and George Soros, though achieved through a very different methodology. While Buffett is known for long-term value investing and Soros for bold, reflexivity-driven trades, Druckenmiller's reputation rests on his ability to deliver high returns consistently with disciplined risk control. In closing Duquesne Capital in 2010, Druckenmiller made a decision that also reflects his long-term discipline. He explained that he no longer wanted to deal with the stress of managing outside money, fearing that his ability to perform at a high level might decline if he continued indefinitely. This decision demonstrated that he not only mastered financial markets, but also mastered the personal dimension of knowing when to step back. Unlike many traders who burn out or destroy their reputations by overstaying their careers, Druckenmiller exited gracefully while still admired and respected. Beyond his trading record, Druckenmiller also contributes valuable insights on economic policy and the role of central banks. He has often warned about the dangers of excessive monetary easing and the buildup of unsustainable debt. In his view, many crises are born not from random shocks, but from structural imbalances created by policymakers and market participants ignoring long-term risks. His commentary serves as a reminder that traders must be aware not only of immediate price action, but also of underlying systemic vulnerabilities. For modern traders, Druckenmiller's legacy offers several timeless lessons. First, consistency comes not from constant trading, but from disciplined risk management and patience. Second, flexibility is vital. Markets evolve, and stubbornness can destroy capital. Third, traders must understand macroeconomic forces, since major moves often arise from shifts in policy, global demand, or systemic imbalances. Fourth, conviction is essential. When the right trade presents itself, a trader must size up aggressively and without hesitation. Finally, humility is indispensable. Even the most successful trader must accept mistakes, learn from them, and adapt. Druckenmiller himself has summarized his philosophy in simple yet powerful advice. The way to build long-term returns is through preservation of capital and home runs. You can be wrong a lot, but as long as you preserve capital, and then you really press it when you're right, that's how you make money. This principle encapsulates the essence of his career. He does not claim to have perfect foresight. Instead, he builds an approach that allows for frequent small losses, but occasional massive gains, with the overall balance skewed toward long-term profitability. In many ways, Druckenmiller represents the ideal of the consistent macro trader, Someone who blends intellectual analysis with practical discipline, who avoids unnecessary risks while seizing large opportunities, and who manages not only money, but also himself with remarkable control. His record remains a benchmark for aspiring traders and professionals across the financial world. While his style may not be easily imitated, his principles can guide anyone seeking to navigate the complexity of global markets. Today, Druckenmiller continues to share his views publicly, offering insights on markets, economics, and policy. He has become a respected voice not only for traders, but also for policymakers and academics who value his unique perspective. While he no longer manages outside money, his influence endures, and his career stands as a lasting example of what disciplined, intelligent trading can achieve. For anyone seeking to understand how to achieve not just occasional brilliance, but enduring excellence in financial markets, the story of Stanley Druckenmiller is essential. His life reminds us that great traders are not defined by a single bold bet or a short burst of success, but by the ability to survive, adapt, and thrive over decades. His consistency, perhaps more than any single trade, is what elevates him to the ranks of the true masters of trading. Conclusion: timeless lessons from the masters of trading. As we reach the end of this book, it is clear that the legendary traders we have studied did not achieve greatness by chance. Jesse Livermore, Warren Buffett, George Soros, Paul Tudor Jones, Ray Dalio, Stanley Druckenmiller, and Jim Simons all came from different backgrounds, pursued different methods, and built their fortunes in different markets. Yet their journeys reveal common threads: discipline, risk management, intellectual curiosity, and the courage to act decisively when opportunity arises. Livermore showed us the importance of reading market psychology and the dangers of ignoring discipline. Buffett taught patience, long-term thinking, and the value of investing only in what you understand. Soros reminded us that perception shapes reality, and conviction paired with boldness can change financial history. Paul Tudor Jones emphasized that survival comes before profits, with risk management at the heart of every decision. Dalio's principles showed how structured thinking and radical transparency can build not just wealth, but institutions that endure. Druckenmiller revealed that consistency and adaptability are the hallmarks of a great macro trader. And Jim Simons proved that the marriage of mathematics, data, and discipline can transform the markets entirely. Together, these masters provide us not with a single blueprint, but with a library of wisdom. Their lessons remind us that trading and investing are lifelong journeys, where learning never ends, and where personal growth is as important as financial gain. If you have absorbed the stories and strategies in these pages, the next step is to take action. Develop your own approach, respect risk, remain humble before the markets, and keep learning every single day. The path of a trader is never easy, but it is always rewarding for those who commit with discipline and passion. For more insights, deep discussions, and practical guidance on trading psychology and strategies, I invite you to subscribe to the Trading Mindset Lab channel. There, you will find ongoing lessons, reflections, and conversations designed to help you sharpen your edge and strengthen your mindset, just like the masters we have studied. Your journey is just beginning. Stay disciplined, stay curious, and keep moving forward.